And we're back. So we left off discussing what is known as the accounting equation, which we said consists of three elements: assets, liability, stockholders' equity. Let's take a deeper dive into the accounting equation and talk about these different elements. Let's begin with assets. Assets are the resources business use to conduct their operations. The resources a business use to earn money are called assets. So, what does that mean? Well, let me give you a different definition that may be a little clearer to you. Assets are things of value that are owned or controlled by a company that they're going to use in order to earn revenue for that business organization. And I'll just explain that in more detail as we go along. Then you have liabilities and you have stockholders' equity. So the equation says assets equal liabilities plus stockholders' equity. Well, liabilities, remember we talked earlier, if I'm trying to start my own business and I need capital, I need resources. One way to get those resources are from borrowing money, creditors. So if the assets come from creditors, then the creditors have claim against those assets. Creditors are known as liabilities. Liabilities refer to the existing debts or obligations of a business. So let me help you. Do you have any credit card debt? That's a liability. Do you have student loans? That's a liability. Got a car note? Liability. Got a mortgage? Liability. So now you kind of have an understanding what liabilities represent. So let's say if you have a house, your house is an asset, something of value. Okay. But if you still have a mortgage, the finance company has a claim on that asset known as liabilities. That makes sense to you? Okay. Stockholders' equity. Remember, we said another way to receive funding is through investors. Investors now own a percentage of ownership into your business organization. So when you have investors, they go up on the stockholders' equity section because the investors also have claim against assets of the actual business. Now, the equity section can be broken down into two components, what we call common stock and retained earnings. As we go through our presentation, we'll talk more about these sections of the accounting equation. Okay? So this equation says assets equals liabilities plus stockholders' equity. This equation is used by companies to record and keep track of all of their business transactions. Let's talk a little bit more in depth about stockholders' equity. There are two components that make up stockholders' equity. One section is called common stock. Let me ask you all a question. Do you own stock in any company? If you say yes, then guess what? You are part owner of that business organization. So when a company issues common stock, they are selling ownership interest into their business. So if that stock is being sold by Apple, Google, Tesla, etc., when they issue shares of stock, it goes to a section known as common stock. Okay? Retained earnings. As a company makes a profit from providing services, selling products, or it could be a combination of those two, the amount of money retained inside the business is known as retained earnings. So we'll talk about how to determine the amount of retained earnings, but this section shows the amount of profit that was not paid out to the stockholders in form of dividends, but that was kept inside of the company. They're retaining their earnings. And we're going to see how to use this equation in more details to record business transactions. All right. So retained earnings will increase stockholders' equity, meaning that we've made an actual profit. When you are a stockholder, so again, I asked a question earlier, if you own stock in any company, and some of you I'm sure said yes, you may receive what's called dividends on occasion. Dividends are payments made to the stockholders of a business. It's a distribution of assets that come from the earnings. So let's talk about that in more detail. So remember, if you are a stockholder of a company, you are part owner, right? So if you own stock in Tesla, Google, Amazon, you are a part owner of that business. So if Amazon makes a profit, you're saying, hey, I'm part owner. Where is my share of that profit? Your share comes in the form of what's known as a dividend. Now, let me caution you, not every corporation pays out dividends. So if you're buying stock in any company, do your research to see if that company issues what's known as dividends. Okay? So here are examples of different types of assets. So again, assets are the resources, things of value owned by a business organization. Cash, equipment, buildings, land, or examples of different types of assets. So do me a quick favor, look around and see what type of assets do you possess. So liabilities again refers to the debts of a business, the amount owed to creditors. We have to keep track of the amount owed to the different creditors of a business organization, same as you do. You keep track of the amount owed for your mortgage payment, for your car note, for your student loan. Do the same thing in business. And then stockholders' equity, those two components, retained earnings and common stock, we're going to keep track of those as well. Now, in accounting, remember, our goal is to keep track of a company's financial information. We have something known as accounts, which means that every different asset has its own account. There's a cash account, an equipment account, a building account, a land account. And those accounts are used to keep detailed information about those different types of accounts. So if I want to know the amount of cash I have, I'll take a look at my cash account and etc. Okay? Now, not all companies are going to use the exact same accounts or account names. So I'll give you some general accounts that's used frequently, but keep in mind that these account titles are not going to be used all the time by all the companies. But once you understand the types of accounts, such as asset, liability, equity, that will help you know how to properly categorize these different accounts. Okay? There's something called an accounting period. An accounting period. What is that? Well, that's the amount of time that company report about their business activities. So the accounting period might be a week. The accounting period might be for a month. An accounting period might be on a quarterly basis, means every 3 months, or it could either be on an annual basis. But companies keep track of their financial transaction over some type of artificial time period known as an accounting period. So again, I'm going to keep it personal. When you think about yourself, perhaps you want to know about how much money you have coming in your expenses. Perhaps you do a weekly budget or a monthly budget or a quarterly budget. So whatever time period that you choose to do those reports is known as your accounting period. Okay. So an accounting event, sometimes called a business transaction, is an economic occurrence that changes an enterprise's or business assets, liabilities, or stockholders' equity. They work together. So a business transaction is a particular kind of event that involves transferring something of value between two entities. So when you combine these together, when you think about an actual company, when they provide a service, sell products, pay their taxes, pay rent, insurance, these are all examples of different type of accounting events or transactions because they're going to impact that company's assets, liabilities, and or stockholders' equity. So now we're going to practice because accounting is an action verb. The way to learn about accounting is by going through and learning how to record different types of business transactions. Okay, first up, Rustic Campsite was formed on January 1st when it acquired $100,000 in cash from issuing common stock. So first, when you read this business transaction, accounting transaction, you need to ask yourself, what does this say? Well, this company, Rustic Campsite, issued shares of common stock, which means stockholders bought the stock, and they receive in cash $120,000. So your job is to record this transaction using what's known as the accounting equation. So first you want to ask yourself which categories were impacted by this transaction. Well, we received cash, right? So cash is an asset. So your cash account increased by $120,000. Now that's great. But if your cash account increased, what caused the increase in your cash account? In this case, the increase came from common stock. Common stock also increased by $20,000 because that's the value of the stock that was issued to the stockholders. Now, very, very, very important, people. This accounting equation must always be in balance. Your assets must always equal your liabilities plus your stockholders' equity. Because if there's an increase in cash, that's a resource. There has to be a source of that increase, right? Meaning, where did the cash come from? Did I provide a service? Did I borrow the money? In this case, we issue shares of common stock. So the count equation must always be in balance. Your assets must equal liabilities plus your stockholders' equity. That's known as the double entry bookkeeping, which means that for every transaction, at least two accounts are going to be impacted. For this example, those two accounts were the cash account as well as common stock. Want some more? Okay. Next transaction. Acquire an additional $40,000 of cash, this time by borrowing money from a creditor. So again, identify which accounts are going to be involved in this business transaction. Now notice under under assets, you're going to have your different type of asset accounts, such as cash or land. In this case, your cash account just increased by $400,000. But where did the cash come from? Well, your cash came from a creditor. Liabilities. Your liabilities also increased by $400,000. But note on liabilities, you have what's called a notes payable, meaning that you're going to have different types of liabilities. So again, your car note is one liability. Your mortgage is a different liability. Student loan is also different. So you're going to have a different type of liability count to identify whom the money is actually owed to. Okay? So do me a favor, look up notes payable to see what notes payable represent. And we're going to come back with another video for chapter 1. See you soon.